Hey everyone, it's Mike from Order Flows, and welcome to the Strategic Order Flow Trading course. This is Module 1 on Strategic Order Flow. All right, so first I want to express my sincere appreciation and thank you for joining me in the Strategic Order Flow trading course. I'm thrilled you have taken this step to advance your trading skills, and I'm excited to help you master the proven concepts that have transformed my own success and consistency as a trader. Now, these methods you'll learn surrounding order flow analysis are powerful, and I'm grateful for the opportunity to share this knowledge with you. Throughout our journey here, my goal is to not only provide valuable education, but also inspire the same passion for markets and order flow that has made trading such an incredible pursuit for me. With an open mind and focus on applying these strategies, I'm confident that you'll gain a new perspective and an edge. So let's get started. So one of the key components in understanding the dynamics of the financial markets is the analysis of order flow, particularly the activities of the so-called smart money, right? You always hear that term a lot. The institutional investors with vast resources and information at their disposal. So being able to identify the institutional buying and selling activity is crucial in making informed trading decisions. Institutional investors such as pension funds, mutual funds, hedge funds, they often possess a significant amount of capital, which allows them to move markets when they enter or exit positions. So their actions have a substantial impact on prices, and detecting their order flow can offer a competitive advantage to individual retail traders, right? Everyone always says you got to follow the money, right? Specifically, follow the smart money. But part of the problem is if you're looking at a normal bar or candlestick chart, you can't determine whether, there's smart money getting involved or if it's just retail money that's getting involved because, you're missing out the most crucial piece of information, which is the volume. Now, from an institutional standpoint, when executing large trades, it's important to consider the potential impact costs that may arise, the execution alpha. By placing a large order, it can disrupt the normal trading activity in a market, causing the price to move against the trader, right? That's why, you always hear about, the big traders trying to disguise what they're doing in the market, right? Now, this price movement due to the trade's impact is called market impact. And the larger the trade size, the greater the market impact as more counterparties need to be found to take the other side. So impact or execution costs refer to the implicit costs incurred from the adverse price moves that occur from executing a large order. These costs arise from informational asymmetries in the market. Other traders may see the large order being filled and alter their trading strategies, right? You always hear about, people that trade on a dome, right? They're always talking about when they see a large order hit the market that, that's when they're getting involved. So, widening their spreads or changing the price limits, the other traders that are there is going to exacerbate the price swings. Now, the urgency to complete the trade also means accepting a wider bid-ask spread, right? Because if a big trader gets more aggressive on his big order, it's going to scare other people away. And, they're going to have to they have to accept that there's going to be wider bid-ask spreads as they start removing liquidity from the market. Right? Or, a market is simply moving as other traders try to front run the big order and thus results in higher impact costs for the big trader. All right. So, if you're looking at a footprint chart, you can see when a big order is being worked through the market, and there are several clues. Obviously, you have, pieces of order flow such as delta imbalances and points of control, as well as the volume that's being traded on the bid, the volume that's being traded on the offer. So, for example, in this chart right here, you can see that there's a big trader is working his way through with a big order. How can I tell? Okay, well, obviously the imbalances, right? It starts with a sweep oftentimes, get me, they sort of want to front load their order, right? Say a trader's got 5,000 E-minis to buy, right? And the market's trading 44.29. He wants to buy as much as possible, as soon as possible, because he knows that that's going to have an impact on the market. So it often starts with a sweep. And when you have the sweep, you have the imbalances, right? You're going to see volume increase, right? The bar's volume is going to be more than the previous bar's volume. Obviously, you're going to have a strong delta. You're often left with, a point of control up near the top because point of control is migrating throughout the bar. Then, he's going to pause for a while, and you're often going to be left with those selling imbalances at the top of green candle if it's a buy order, be the opposite logic for a sell order. And then you're going to see it start up again, right? The aggressive buying coming in on decent volume, right? You're going to see some bids filling in on the way up, meaning that he's not just lifting the offers, but they're working the bids, right? And to me, this order, basically started around 29 and ended up here around 33, 33 and a half. Right up here, you can see where it finally gets the final aggression, the big offers being lifted, followed by the big bids coming in as the guy is finishing up his order. But he doesn't care that the market is now trading 44.33. He started buying it at 44.29. What he's looking at is his average price for this order. So now the market's trading 44.33. His average price starting at 29 all the way up to 33, is probably somewhere around 30 and 3/4, 44.30, spot 75, maybe 44.31. So even though the market is trading 33, he's happy. He started it at 29, but his average price is, around the 44.31 area. Now, to minimize impact costs, big traders usually break up large orders into smaller chunks and use algorithms to execute the slices over time. Right? The algorithms aim to detect periods of lower liquidity risk and trade more aggressively then. Basically, when there is volume in the market. So trading patiently over an extended period allows absorbing the order flow in a way that reduces artificially moving the price. Because remember, right, they don't want to just come in, telegraph to the world, hey, everyone, I've got a big order here. I'm going to start buying. Because you do that, everyone and their brother is going to start buying as well. They want to sort of keep the cards close to their chest and not let other traders or basically the world know that they're coming in and buying. At the end of the day, trading is a competitive endeavor, and you don't want to be giving clues to other people of what you're trying to do in the market. So executing through execution algos also avoids signaling a large order to the entire market. So considering the impact costs and mitigating their effects through smart order execution helps large traders trade efficiently while maintaining market integrity, right? You don't want to just, cause a lot of volatility in the market because you have a large order to execute. You don't want to do this. This is the slide that I just showed you, right? You don't want to leave, this big trail here necessarily if you don't have to, right? What am I talking about? The 0, 0, 0, 0, meaning that's so indicative of a sweep. Now, we had just been trading here, right? Remember, we had just been trading around this 29 to 28 level. Then a big buyer comes in and lifts every single offer, right? And it just leaves this trail here that, again, if you're looking at a bar chart, you're not going to see this. You're only going to see it on an order flow chart, right? You want to have it a little bit more disguised as you're seeing what's happening up here. But again, this is the benefit of using the order flow chart is you're going to see this kick off this move, right? You're often going to see it start at the move from the beginning, right? Now people say, well, what about this here, right? Something similar, right? The 0, 0, 0, right? With the aggressive buying taking place. Yeah, but at this point now, what you have, right? This is the first clue down here when you just come down into a low before you rally, right? Because once you start rallying, now you're being, market prices moved already, 5, 6, 7 points. And now what's happening is this is the result of the large order coming in. It's attracting, the trend followers, the retail traders say, hey, you know what? We're trending. They got to get in. And what happens? They get in here. This is like the worst place to get in. The best place is right down in here. And the clues were in this initial market sweep, not this one. Right? Because what's being, other traders are being sucked in thinking, hey, we have a breakout coming. And what happens? The market just goes sideways on them. Oftentimes you see a big order working its way through the market, right? You can see there's heavy volume up here, 2,000. Bids are getting hit right down in here. You see some thin prints, aggressive selling coming in here. Boom, boom, boom. And finally, the guy just says, you know what? I've pushed this market low enough. It's dropped from 44, basically 35, 5 points, 6 points down to 20, the 30 to 29. He said, this is my limit. Don't sell any worse, right? It's like when you, are trying to sell your house and the realtor's like, well, nobody's really interested at your price. Can you lower it? Okay, fine. This is the bottom, 44.30. I can't sell it below that anymore. And that's why you often see like these big offers, on a move that's going down. And people say, I can't push this market down any lower. This is the lowest price I could accept, right? Or if it was going up, it would be on the bid side. Now, order flow analysis involves closely monitoring the volume and direction of trades executed in the market. And by studying the interactions between buyers and sellers, we can identify patterns that indicate the presence of smart money. These patterns may include large block trades, icebergs, aggressive buying or selling, or significant changes in trading volume. By recognizing these patterns, traders can align their own positions with smart money and potentially ride along with them. Now, this is a tricky word here, or phrase, large block trades. It's something that happens in futures every so often between big traders. Now, in futures, okay, now, in stocks, you have the dark pools where people, trade all the time. But in futures, you do have the ability to do block trades. Now, the exchange has very specific rules for that. And basically, people can agree outside of market conditions, right? Outside of the market. And then they post it with the exchange. Now, it doesn't happen very often, but it happens. Okay. So, for example, I've been involved in numerous block trades, in my trading career. And what they would do is like, okay, someone would call the trading desk, hey, I've got to buy 5,000 5-year notes. Can you make me a market? Market's probably 28 and a quarter. Okay. Yeah, I could sell you 5,000, but I could sell it to you at 30 or 29 and a half, a little bit off the market. All right. You got to give me some time to, because I got to offload it. Right. And then you have to post it with the exchange. Means you have to inform the exchange. Now, this doesn't get entered through the actual, trading engine's front end. It's registered with the exchange. So, then the exchange will post it as, a big volume going through at this price. It'll show up eventually in the time and sales. But I just want you guys to realize that block trades do happen, in the markets. Usually it happens in treasuries. I don't think it happens so much in, equities. And, I've been involved in some grain ones, but, we would just do it on the exchange. So someone has to buy like, usually what it involves is a customer that, a customer of the bank or trading firm. They've got a position in a commodity, as you get to expiration, right? You can only hold a certain amount of contracts on the front month. So they'll have to basically move from one end to, get it off their books. So they'll just block trade with another firm, and you'd put it in to the market. Sometimes people see these big bids coming in the order book, right? Where, say the market is like on wheat is 735 bid at 735 and a quarter. All of a sudden there's a big bid at 733. And there's not really anything above it, right? I mean, between 733 to 735, there's maybe 20, 30, 40 contracts. You got to count it off. You got to wait a certain amount of time, 30 seconds. You got to show it out to the world, and then you can trade against it. Okay, so that's another type of block trade. But there are block trades that do happen in futures, but it's pretty rare. But it does show up in the order flow because it's volume, right? So even if it's done off exchange, it does get posted, and the exchange has to put it in the day's volume. Now, liquidity. Okay, so that's why that's what large traders need. Right? They're large. They need liquidity in the market. And oftentimes, a sign to me of, market finding its liquidity is a bar, right? You have this long bar here. This is the market that's looking for liquidity, right? You can see the 4 buying imbalances. And then it gets right here. A very small bar with decent volume. Very small delta, 20. The market has found its liquidity. People want to say, well, 1,600 isn't a lot of volume, because the previous bar was 2,200, but the 1,600 is still decent relative to all the volume that took place prior to it. So, the trader that was going through the market, lifting the offer aggressively, right, buying imbalances, finally hit his liquidity spot up here at 37 and a half, 37 and 3/4, right? That's why this bar isn't a long bar up. This is a long bar because the market is looking for liquidity. Now they found that liquidity here. Now, the smart money's order flow can reveal crucial information about market sentiment, liquidity, and potential price reversals. So, for instance, when a large trader starts accumulating, it suggests they have an optimistic outlook on the underlying asset or market, right? Conversely, if they begin offloading their positions, right, distributing it, it's going to indicate a bearish sentiment. So, what are some of the signs of accumulating? Well, to me, there's, the most obvious sign is putting in the effort, right? You hear this term, I'm going to talk about it later in a later module, is putting in the effort, not getting rewarded. Heavy selling, okay, 1,000 negative delta. Okay, that's good. Market went down. Heavy selling, 1,200 negative delta. What happened? Why is this market going down? Instead buying comes in. Heavy selling, minus 1,200 in the delta. Again, market's not going down. So I know I've got a clue. I've got 2 bars, very strong negative delta. Market's not going any lower. So that's a sign to me that, hey, you know what? We got some we got the aggressive sellers selling it down, causing the negative delta, but you have nice passive buyers in here basically absorbing it. Well, why aren't we trading lower? This is as low as it's gotten, right? And we're going sideways, right? Then you often see the small delta to, minus 110, and then the aggressive buying finally shows up and the market is brought higher. Distribution. What's some of the signs of distribution? Now, distribution is going to come in after a market rallied, right? You're not going to think of distribution coming in at market low. If you're trading at market lows and you're seeing distribution coming in, it's not distribution. It's more of capitulation, people just getting out. When a market's rallying, the traders that had been long from earlier, they want to distribute their position. They want to get out of that position. So one of the signs, right? Obviously, you're going to look for the selling, aggressive selling in the delta, right? Strong negative delta, 1015, 1015, right up here. Then you're going to start looking for supply coming in, right? What's one of the signs of supply coming in is buying imbalances in the red candles. Again, distribution, I'm looking for the market to go down, not up, right? Accumulation, I'd be looking for the market to go up, not down. I'm looking obviously for selling imbalances. You got them here. I've got my buying imbalance here. I've got my buying imbalance here. I've got my buying imbalance here. So it's telling me, when I have a buying imbalance in a red candle, it's telling me there was heavier offers than what was trading on the bid, right? Because it's an imbalance. In this case, it's a buying imbalance. So what's happened, right? Market's coming down. It pops back up. Look at this. You got this pocket of sellers up here, 236, 334, 325, to, in a sense, soak up. I don't want to say use the term absorb because I don't want to confuse you, but basically these passive sellers up here are absorbing whatever is, aggressive buying is taking place to put a stop to this move. Down here you're seeing some heavier volumes, 1,045. Here's 1,300. And the market keeps working its way down. Someone buys 1,000, you're looking for this market to rally. Someone buys another 1,300, you're looking for this market to rally, not sell off. And if you start seeing it tick below that, that's a bearish sign. So the big money refers to large institutional traders like mutual funds, pensions, hedge funds, banks, real money, right? These players trade in very high volume, so their activity tends to have an outsized impact on market prices. When a large trader or institution enters a new long position, they will typically do so by buying at or near the current market price. Their heavy buying interest provides support for that price level. Conversely, when the big money exits or closes out a long position, they sell out of the position often at a specific price. Their selling activity indicates that price level may react as resistance on any bounce higher. So, for example, if a large hedge fund buys 1,500 E-minis at 45.60, the heavy volumes signals that 45.60 is an area of demand, and until that buying interest is satisfied, 45.60 is going to act as support. Okay, so key importance here is, right, new positions, they're going to start buying at or near the current market price for getting into positions. When exiting or closing out, they sell at a specific price. Okay, so just keep that in mind, right? When they're exiting, right, they're exiting at a specific price. Here, 1,600, 44.35. New short position, right? They're getting in at the current market price. As this market is going down, they got to hit the bids. They got to work offers, but they also got to hit bids. That's why you're seeing, imbalances come in. If, it was just a solid offer there and the market keeps banging into it, then that's telling me that, they are exiting that position, right? If say they're 45.58, that's where that's their level to get out. You're going to often see it come back up to that level and trade. But if they're getting into a new position, obviously there's going to be signs. You're going to be looking for the delta to be trending down, right? You're going to be looking for the imbalances. And later on, we'll be talking about points of control, how some point of controls matter more than others, okay? So just be aware of that. What you're looking for is, getting into a new position. They got to get in at the current price, and, they often got to lead it down a little bit. So knowing where major volume enters or exit the market helps gauge pivotal price levels and the strength of trends. Paying attention to the behavior of big money improves your ability to trade key market inflection points. So new long positioning, what are the clues, right? You're going to look at volume, delta, imbalances, point of control. Volume, that's a simple one, right? It's got nothing to do with order flow per se. It's been part of the Dow theory for a long time. As the market is gaining strength, volume is going to increase. Obviously, you're going to be looking at delta increasing as well, strong delta, like this bar right here. You're going to be looking at the imbalances, and what's point of control doing? Point of control is migrating higher in the bar. Because imagine, this bar opened up down here, right? Point of control started at the bottom, it's closing up near the top. So it's migrating higher. So volume or delta spikes is something that gets traders caught off sides. Okay, so oftentimes people say, well, there's a big volume coming in, right? I got to get long, I get short. But a surge in volume could simply be due to an institutional trader quickly offloading a large position for reasons unrelated to market fundamentals. For example, a hedge fund may need to sell a position quickly to meet investor redemptions or portfolio rebalancing needs. Right? The high selling volume is not necessarily indicative of negative news in the market. Right? If the volume spike reflects forced selling that overwhelms buying interest, the price may experience abnormal one-sided volatility, and jumping in on what looks like momentum could mean buying into artificial weakness or strength. So for example, right, the big volume spike up, 14,000 contracts here. We started out in the previous bar, we jumped from, 1,500 contracts per bar, all of a sudden 5,000, 14,000, then you're back down to 5, 11, 6, 3, 3, 3, etc. Right? Don't just see, you got a big volume spike. Oh, everyone's coming in buying. I gotta get long. No, don't fall for that, because it's not necessarily indicative of a trend beginning. Volume spikes down, same thing. Oh, everyone's selling in here. I got this big stacked imbalance in here. They're all just clearing out every single bid. Look at this volume. It's gone from 2,000 basically to 12,000 to 15,000. Oh my gosh, I gotta get in. The market's moving. I gotta get in. This is a 1 minute chart. You can see this market dropped from 46.04 down to 45.91. We just dropped 14 points. I gotta get short. You don't fall for it, right? Just because you see a big spike in volume or a spike in delta, don't let it persuade you to jump in and, quote, go with momentum. The high volume exit of a large trader, either to the upside or to the downside, right, can be a one-off event rather than a sustainable trend. Basing decisions on volume spikes alone increase the risk of mistiming entries and getting caught in reversals, right? You don't want to be, these selling imbalances, they're aggressively selling. I got to get short. You get short down here at 92. 2 minutes later, trading 8 points higher, 4,600, 45.99. That's not what you want to be positioned in. So at best, waiting for the dust to settle after the flurry of activity allows a trader to evaluate whether any emerging trend has legs, whether it's going to continue or not. At worst, it prevents getting run over by sharp contrary moves from temporary volume imbalances. Now, here are some tips to avoid false perceptions of large orders when analyzing the footprint chart, right? Look at full context. Don't assume one long wick. Price action traders love wicks and candles, right? Don't assume one long wick or volume spike alone signals a big order, okay? They'll say, oh, I got this pin bar here. So obviously, sellers drove it down trying to go lower, but then a big buyer came in and took it higher. That's basically what a pin bar is. So compare a relative volume. A wick may seem long, but if overall volume is low, it doesn't necessarily mean there's an excessive order taking place. Watch the volume at the ask versus the bid. Sweeps lift offers and they clean out the bids quickly with very little counter trade. So watch volume trade on the bid and volume trade on the offer. Watch for absorption of orders. Volume transacting shows absorption, right? If Wick prints but doesn't trade, be a little bit more suspicious. So what I mean by that, if Wicks print but don't trade, be more suspicious. There's a saying, if it prints there, it can trade there. So if it spikes down, expect it to trade there. So if it doesn't, then the market's telling you something else. So a long wick, but volume is nothing special, right? Like right here. Okay, yeah, we got a big wick down. But yeah, the volume, 1400, nothing. That's why this market went sideways. People say, well, eventually it went up. Well, yeah, but you got to sit through 1, 2, 3, 4, 5, 6, 7, 8, almost 10 minutes of sideways activity when there's actually more information coming in here that's more accurate that this market's going to go up, right? I mean, you could have been sitting in this position and bearish information came in. In this case, bullish information came in. But again, just because you got a long wick down doesn't automatically give you an automatic trade to the upside, okay? Watch the volumes at the bids and asks in sweeps, okay? So, thin volumes here, 2, 3, right? 2, 0, 2. Here, it's a little bit more counter trade, 82, 49. Okay, so again, watch the volumes, right? In a sweep, it should be, if it's a legitimate sweep, you want some very thin volumes coming into the market. Now, liquidity circumstances. Low liquidity markets make large orders appear bigger than reality. And how to put it in context? We'll put it around the wicks of the candles, right? Are other participants reacting or responding to the supposed large orders or conditional orders? Wicks can form from stops rather than fresh orders. No key risk levels, right? No areas where people might have stops. Because if it's an area, if you get these long wicks in an area where people have stops, it could be the result of stops, okay? Low liquidity makes big orders. Basically, volume look more important than it really is. Okay, so you're seeing it here, right? There's not much liquidity, but a big order came through in the market, found some liquidity, then it's just back to normal low liquidity. It's not that, I got big liquidity coming in here. All of a sudden, we got 4,600 contracts trade. Okay. Is the market looking for liquidity? Because it found it. Then what's going to happen? You got to watch what happens next. Right? It's always important to watch what happens next in the order flow. So volatility in the market is characterized by an increased price ranges and higher trading volumes. Right? That's what you want to see in volatility. So when analyzing, say, a 5-minute candlestick chart, for example, you can identify periods of volatility by observing spikes in price range and volume. These spikes indicate a greater number of prices being traded, highlighting the presence of volatility. However, it's important to note that volatility does not necessarily imply a trend. It merely signifies increased trading activity. Okay, don't fall into this trap. I see this a lot. People say, there's volatility in the market. That's great because now the market's going to trend. No, it's just going to go up and down oftentimes, right? Because now you have increased trading activity. It doesn't necessarily, we like to think it's going to potentially be the start of a trend. I mean, if you remember during COVID, volatility's, off the Richter scale and you got a lot of trends, but there are times off, that's an outlier. There's a lot of times where you got increased volatility and it's just market up and down. And if you're trying to trade that, you're going to get, you can get shellacked. You can get, churned in the market more often than you like. So you can see volatility rises, price bars are getting longer. You're getting those imbalances in the market. You're getting the heavier volume, getting the stronger delta. And then volatility decreases. Once the market sort of found liquidity, you can see how the bars got a lot smaller here, here. Volume is getting a lot smaller. So volatility rises, volatility decreases. So to further understand volatility, traders can examine the price locations associated with its occurrence. By observing price levels, it becomes evident that volatility can manifest at both lower and higher price points. People think that market's volatile, it's going to go higher. No, it can also go down. So furthermore, it's essential to identify where volatility is predominantly driven by sellers or buyers, right? Who's in charge of this volatility? Who's driving it, basically? So while there may be some volatility stemming from buyers, it's often more prevalent on the sell side, right? You see this a lot, right? Markets drop a lot faster than they go up. Well, although now, in 2023, it seems this market just defies gravity. The market just goes down a little bit, then it moonshots. But in general, markets fall a lot faster than they rise. And this observation can provide valuable insights into potential direction of price movements. So order flow analysis and identifying institutional buying and selling are essential aspects of market analysis, right? Recognizing the activities of smart money can provide valuable insights into market trends and potential trading opportunities. So by carefully studying order flow patterns, volume price action, we can improve our decision-making process and potentially capitalize on the actions of, quote, informed traders, the smart money, right? We all assume that the smart money's got better information than us. So this concludes Module 1. In Module 2, I'll discuss enhancing your order flow trading performance. So I'll see you there.